Three financial catastrophes, separated by nearly a century each, share a pattern so precise it demands our attention. In the summer of 1842, 9 American states defaulted on $198 million in debt, triggering an international crisis that paralyzed the young republic for half a decade. On September 21st, 1931, Great Britain abandoned the gold standard as capital fled the country, collapsing a monetary system that had anchored global commerce for generations. And on September 15th, 28, Lehman Brothers filed for bankruptcy protection with $639 billion in assets, igniting the worst financial crisis since the Great Depression. These weren't random accidents of history. They were the inevitable consequences of a pattern that repeats with mathematical regularity across centuries, continents, and economic systems. The terrifying truth is that this pattern is unfolding again right now. And if history is our guide, what comes next will reshape the American economy in ways most people cannot yet imagine. Every major financial crisis follows a 3-stage pattern that operates with the precision of a ticking clock. First comes the credit expansion phase, where borrowed money floods into a single asset class, driving prices to unsustainable heights, while everyone believes the boom will last forever. Second arrives the confidence shock, a sudden event that exposes the fragility of the entire system and triggers panic among creditors, who race to withdraw their funds. Third emerges the deflationary collapse, where asset prices plummet, debtors default en masse, and the real economy contracts in a downward spiral that can last for years. This pattern isn't theory. It's historical fact, documented across 3 of America's most devastating economic crises. Understanding how credit expansion inevitably leads to financial catastrophe is the key to recognizing where we stand today and what dangers lie immediately ahead. The mathematics of debt accumulation and collapse operate independently of technological progress or regulatory sophistication. The American economy of the 1830s was intoxicated by infrastructure. Canal mania swept the nation as states borrowed furiously to build waterways connecting the interior to coastal ports, convinced these projects would generate limitless prosperity. Between 1830 and 1841, total state debt exploded from just $14 million to an astronomical $198 million, a 14-fold increase in barely a decade. This borrowing binge was financed almost entirely by European investors, particularly British banking houses that eagerly purchased American state bonds at premium prices. President Andrew Jackson's destruction of the Second Bank of the United States in 1833 removed the only institution capable of restraining this credit explosion. Without a central bank to regulate lending, state-chartered banks issued paper money with reckless abandon, fueling speculative land purchases across the frontier. Jackson's specie circular of July 1836, which required payment for public lands only in gold or silver, was designed to curb this speculation. But it achieved the opposite effect by draining hard currency from banks and creating a liquidity crisis. The confidence shock arrived in May 1837, when New York banks suspended specie payments, unable to convert paper notes into gold. The crisis deepened through 1839 and 1840 as cotton prices collapsed, state revenues evaporated, and the infrastructure projects failed to generate expected returns. Michigan became the first state to default in July 1841, refusing to honor $5 million in bonds. By summer 1842, 9 states and territories had defaulted on their obligations, sending shockwaves through European financial markets. The consequences were catastrophic. Over 40% of all American banks failed between 1837 and 1844. Unemployment soared as businesses closed their doors. Deflation gripped wages and prices for 7 years. The crisis shattered America's reputation in international capital markets, making foreign investment nearly impossible for a generation. What began as optimistic infrastructure investment ended in ruin because the debt was built on speculative fantasies rather than genuine economic productivity. The collapse demonstrated that borrowed capital cannot create prosperity when the underlying investments fail to generate sufficient returns. The global economy of the 1920s was built on a fragile foundation of post-war reconstruction and credit expansion. Central to this system was Britain's return to the gold standard in 1925 at the pre-war exchange rate of $4.86 per pound, a decision that overvalued sterling and made British exports uncompetitive. European banks, meanwhile, extended massive loans to finance reconstruction, creating interconnected webs of debt that spanned the continent. The confidence shock originated in Vienna, not London. On May 11, 1931, Austria's largest bank, Credit Anstalt, revealed it was insolvent after absorbing losses from failed industrial companies. The panic spread rapidly to Germany, where banks faced massive withdrawals as depositors feared contagion. German banks held substantial Austrian assets, and British banks held substantial German loans, creating a chain reaction that traveled across Europe in a matter of weeks. Britain attempted to defend the pound through traditional means, raising interest rates and borrowing gold from France and the United States. But the flight of capital was relentless. In just 3 days between September 17th and September 20th, 1931, approximately $38 million in gold flowed out of British reserves as foreign investors and domestic savers converted pounds to gold. The Bank of England's gold reserves, which stood at approximately $130 million, were hemorrhaging at a rate that made maintaining the gold standard mathematically impossible. On September 21st, 1931, Britain abandoned the gold standard. The pound immediately depreciated by 25% against gold. The decision sent shockwaves through the global financial system, as Britain had been the anchor of international monetary stability for over a century. Nations that remained on the gold standard faced intensified pressure. The crisis crossed the Atlantic when foreign investors, fearing America would follow Britain's lead, began converting dollar assets to gold, triggering banking panics across the United States in 1931 and 1932. The deflationary spiral that followed was merciless. American GDP fell 4.3% from peak to trough. Unemployment in Britain reached levels not seen since the Victorian era. International trade collapsed by 2/3 between 1929 and 1933. The crisis demonstrated how interconnected credit systems, built on the illusion of permanent stability, could transmit failure across oceans with devastating speed. What began as a single bank failure in Austria ended with the collapse of the global monetary order. The credit expansion of the early 2000s dwarfed anything seen in previous American history. U.S. home mortgage debt relative to GDP increased from 46% during the 1990s to 73% by 2008, reaching $10.5 trillion. Total household debt soared from 61% of GDP in 1998 to 97% in 2006. This explosion was fueled by financial innovation, specifically mortgage-backed securities that allowed banks to originate loans, package them into complex instruments, and sell them to investors worldwide. The system operated on a simple but fatal assumption. Housing prices would continue rising forever. Subprime mortgages, extended to borrowers with poor credit histories, were considered safe because even if borrowers defaulted, rising home values would protect lenders. Banks leveraged these assumptions to increase their lending, while investment firms used borrowed money to purchase mortgage-backed securities, amplifying returns during the boom but magnifying losses when the bubble burst. The confidence shock began in 2007 as housing prices started declining and subprime mortgage defaults accelerated. By March 2008, Bear Stearns collapsed and required emergency acquisition by J.P. Morgan Chase. The Federal Reserve and Treasury Department hoped this intervention would stabilize markets. They were wrong. On September 15, 2008, Lehman Brothers filed for bankruptcy with $639 billion in assets, the largest bankruptcy in American history. The next day, AIG, a massive insurance company that had guaranteed billions in mortgage-backed securities, required an $85 billion government rescue. The deflationary collapse was swift and brutal. U.S. household net worth declined by nearly $13 trillion, a 20% loss of wealth. Housing prices fell 30% from peak to trough between 2007 and 2011. The unemployment rate soared to 10% as businesses cut millions of jobs. Stock markets lost half their value. The crisis spread globally because foreign banks held enormous quantities of American mortgage-backed securities, creating the same contagion pattern seen in 1931. What made 2008 particularly dangerous was the size of the credit expansion that preceded it. Mortgage debt alone reached levels never before seen in peacetime. When that debt could not be repaid, the losses cascaded through a financial system that had convinced itself that sophisticated risk models had eliminated the possibility of systemic failure. The pattern was identical to 1840 and 1931, only the scale had grown exponentially. The hubris of believing that financial engineering had conquered the ancient laws of credit and debt proved catastrophically misguided. The credit expansion of the 1920s carries eerie similarities to the periods preceding previous crises. As of the third quarter of 2025, total U.S. household debt stands at $18.59 trillion, a new record. Mortgage debt comprises $12.61 trillion of this total, having recovered to levels approaching the 2008 peak. Credit card debt has surged to $1.21 trillion, with delinquency rates rising across all income levels, suggesting borrowers are increasingly unable to service existing obligations. Corporate debt presents an even more concerning picture. U.S. non-financial corporate debt has reached levels exceeding 70% of GDP, near historic highs. The Federal Reserve's extended period of near-zero interest rates from 2008 to 2022 encouraged corporations to borrow aggressively, often using debt not for productive investment but for stock buybacks and dividend payments. This debt must now be refinanced at interest rates significantly higher than when it was originally issued, creating a refinancing crisis for companies with weak cash flows. The parallels to previous crises are impossible to ignore. In the 1830s, states borrowed to build canals. In the 2000s, households borrowed to buy homes. Today, corporations have borrowed to engineer financial returns. Each era featured widespread confidence that debt levels were manageable because future growth would make repayment easy. Each era was wrong. The warning signs are multiplying. Private credit markets, where non-bank lenders extend loans to risky borrowers outside traditional banking regulation, have exploded to over $1.5 trillion. Commercial real estate faces enormous stress as office buildings sit vacant following the shift to remote work, with an estimated $1.5 trillion in commercial mortgages requiring refinancing through 2025 at much higher rates. Regional banks hold enormous concentrations of these loans, creating vulnerability to the same kind of localized panics that triggered broader crises in both 1840 and 2008. History teaches that credit expansions of this magnitude never end peacefully. The only question is, what will provide the confidence shock that exposes the system's fragility? The deflationary mechanics of a modern credit crisis would follow a predictable but devastating path. Rising defaults in commercial real estate could trigger failures of regional banks that hold concentrated exposures to these properties. Unlike 2008, when large money center banks faced the crisis, a wave of regional bank failures would be harder to contain and could spark deposit runs across the banking system. Federal deposit insurance protects individual accounts, but it cannot prevent the credit contraction that follows when banks stop lending to preserve capital. Corporate defaults would accelerate as companies with weak balance sheets prove unable to refinance maturing debt at higher interest rates. The high-yield bond market, where riskier companies borrow, shows signs of stress as spreads widen and new issuance becomes difficult. Corporate bankruptcies would force layoffs, reducing consumer spending and creating a feedback loop that weakens the entire economy. The private credit market, which operates with less regulation and transparency than traditional banking, could experience rapid withdrawals as investors recognize their exposure to failing borrowers. The confidence shock could originate from any number of sources: a geopolitical crisis that disrupts global trade, a sovereign debt crisis in a major economy, or a technological disruption that renders entire industries obsolete overnight. The specific trigger matters less than the underlying fragility. Once confidence breaks, the deflation accelerates through predictable channels. Asset prices fall, borrowers default, lenders contract credit, economic activity slows, unemployment rises, and the cycle reinforces itself. Government responses will mirror previous crises, but may prove less effective. In 1842, the federal government had no capacity to intervene in state finances. In 1931, central banks lacked the tools and will to support the gold standard. In 2008, massive fiscal and monetary intervention prevented a complete collapse but created enormous public debts that now limit policy flexibility. The next crisis will unfold against a backdrop of government debt exceeding 120% of GDP and interest rates that, while lower than historical averages, are far above the near-zero levels that prevailed after 2008. The policy toolbox is significantly more constrained than it was during previous crises. The timeline for such a crisis is impossible to predict with precision, but the pattern suggests it arrives not gradually but suddenly. Credit expansions can persist for years, even a decade, as participants convince themselves that this time is different. But the confidence shock, when it arrives, unfolds in weeks or months. The 1840 crisis took nearly 5 years to fully develop. The 1931 crisis moved from Vienna to London in 4 months. The 2008 crisis went from Bear Stearns to Lehman Brothers in 6 months. The next crisis will likely move even faster, as modern financial markets operate at electronic speeds. The velocity of panic has accelerated with each successive crisis. The conventional wisdom suggests that policymakers have learned from past crises and built systems to prevent their recurrence. This belief is dangerously wrong. The fundamental pattern that causes financial crises has not changed in nearly 2 centuries because it stems from immutable aspects of human psychology and economic incentives. Credit expansions occur because borrowing generates immediate benefits while the costs remain hidden until the future. Borrowers and lenders convince themselves that current conditions will persist indefinitely. Regulators and politicians encourage credit growth because it creates the illusion of prosperity. The contrarian truth is that every attempt to prevent financial crises through regulation and oversight has failed because these efforts never address the core problem, the tendency of credit to expand beyond the economy's capacity to service it. The regulatory reforms after 1840 didn't prevent 1931. The reforms after 1931 didn't prevent 2008. The reforms after 2008 will not prevent the next crisis. What differs across these crises isn't the pattern, but the scale. The debt levels preceding each successive crisis have grown larger relative to GDP. The interconnections between markets have grown tighter through technology and globalization. The speed at which panic spreads has accelerated. These developments suggest the next crisis will be both larger and faster than its predecessors. The systems designed to contain financial instability have themselves become sources of systemic risk. The most important insight from studying these three crises is recognizing that financial stability is always temporary. Periods of apparent calm breed the complacency that enables the next credit expansion. We are currently in such a period where memories of 2008 have faded enough to permit the accumulation of dangerous debt levels. The confidence that current conditions will persist is itself the warning sign that they will not. History doesn't repeat, but it echoes with remarkable consistency. The 1840 panic showed how state infrastructure debt could paralyze a nation. The 1931 crisis demonstrated how interconnected credit systems transmit failure across borders. The 2008 meltdown revealed how housing debt could threaten the global financial system. The next crisis will teach its own lessons about whichever form of credit expansion we're currently experiencing. Each iteration of the pattern grows more complex, but follows the same fundamental arc. The pattern is clear for those willing to see it. Credit expands beyond sustainable levels. A confidence shock exposes the fragility, and deflation follows as the system contracts. We are somewhere in the expansion phase right now, accumulating debts that cannot be fully repaid. The shock will come from a direction most analysts aren't watching. And when it does, the deflationary mechanics will unfold with the same brutal efficiency they demonstrated in 1840, 1931, and 2008. The mathematics of debt and collapse operate independently of human optimism or technological innovation. The question isn't whether another crisis is coming. The question is whether we'll recognize the pattern before the shock arrives, or whether we'll once again convince ourselves that this time is different. If history is any guide, we know the answer. The pattern never fails, only our ability to see it does.